All right, on today's episode, we interviewed Bryan Rand, where we really dived into what it looks like to be an independent sponsor. And in his world, right, there's really two sides to it. There's kind of the growth side around finding an existing technician and really jet fueling them to go and complete a successful company and building it up. And then the other side of it is buying a legacy business. And I mean, it's a really a jam-packed session. So Casey, what are some of your takeaways?
Feras, as an entrepreneur doing acquisitions and doing this stuff, we always think about scale. We think about how do we do more than one? What does it look like? Oh, I need a holding company. And how do I take this holding company and grow and scale? And do I have to always personally guarantee the SBA note? And how do I get capital? I mean, this is the whole world of independent sponsor. Okay. It is a whole new conversation for most people. And I'm telling you, dive right in. This is just a wealth of information. Bryan is a superstar. And there's a lot happening in that space.
Yeah, and there's a lot of information, right? It's about having the right tools. And again, we kind of dive into one example where he's able to buy a business and own it 100%, right? Brought a little bit of equity, but again, with the right structuring, with the right tools, you're able to go accomplish some really cool things in the independent sponsor world. So that's this episode.
All right, guys, just take 1 second here real quick. When you're buying a business, ensuring the financial health of the company is critical. And that's where a quality of earnings partner comes in. Quality of earnings gives you confidence in the financials of the company that you're purchasing. It aims to protect your investment and ensure that you're stepping into a profitable business on day one. Patrick of O'Connell Advisory Group is your dynamic quality of earnings partner. He's here to help you buy the right business on your timeline. Patrick's entire practice is focused on business acquisitions. Your niche is his niche. And over the past decade, Patrick's helped more than 200 buyers like yourself successfully purchase and operate enduring, profitable businesses. In fact, Patrick's helped some listeners of this show. So if you're buying, looking for help with the quality of earnings, financial due diligence, network capital, and more, head to o'connelladvisorygroup.com or just click the link in the show notes. Bryan, welcome to the show.
Thank you. Happy to be here.
I'm excited to have you on. I heard a lot of great things. So Casey spoke highly of you. So go ahead, Casey.
Yeah, no, we were at the conference, and I always say the law firm's name wrong, but
McGuire Woods. Yeah,
McGuire Woods conference. Bumped into you in the hallway. You were looking good. You looked sharp. You had your flyers. You were hustling. And I was like, I got to talk to this guy. And man, you blew me away because, we've been more into the mindset, going to these ETAs, talking more of the search model, right? Thinking about that world. And then I got introduced to the word independent sponsor last year. And it just, okay. Then I went to the conference. And you explained it for me in 10 minutes. I was like, we've got to have you on this podcast.
Yeah, because we did our own deal, right? And we knew we weren't ETA. We didn't quite know what we were. And then Casey went to that conference, came back, it's like, all right, I know exactly what we are now. So independent sponsors. So Bryan, for those listeners, do you want to maybe go ahead and explain what is an independent sponsor? And then after that, kind of just dive in a little bit of your background, right? And kind of how you got into where you are today.
Sure. So let me take it in that order. So, an independent sponsor is either a person or a group who is actually going to purchase a business and drive the governance and operations of the business, but not as a day-to-day operator. Right. And so similar to what a funded private equity firm would do, really kind of identifying the business, going out, finding and negotiating with the owner of that business, closing on that business, and then driving, often like finding a CEO, driving the management team, driving and pushing to exit. Where they're different than a private equity firm is rather than having raised a large pool of committed capital, they've actually on a deal by deal basis find both the debt and the equity to do that deal. And so, for years they were called fundless sponsors, and people would kind of be dismissive and say, well, how can you buy a business without a fund? But now the market's evolved, and we've gotten to a point now where there are a number of providers of both equity and debt who love to back independent sponsors. There's families who are excited to say, hey, rather than committing upfront to a 5 to 10 year period where I don't know what I'm getting and doing blind pool investments, having someone come with a deal and then being able to invest in that specific deal. And then frankly, for investors and company builders and independent sponsors and folks like myself, there's actually a lot of value to having the potential upside tied to that one deal you're excited about, rather than blended into a fund where any one deal going bad could blow up the returns, versus if the money is there, deal by deal is the way to go. So that's sort of what an independent sponsor is.
And really quick, how's that for the listeners that are probably asking the same question? What makes it different than a searcher or ETA?
Sure. So, I think if you look at kind of search and often, especially funded search, and I say this with respect to all the ETAers out there and the searchers out there, there's multiple ways to do it. But I look at funded search and it reminds me of like 1990s rap deals. Like they're terrible deals, right? That in exchange for an 80K salary, all of the upside gets eaten away, right? And so, for us, when you kind of think about sort of the difference, a lot of the ETA and search space are really with the idea that the person doing it, the person doing the search will actually go run the business, right? That's typically the model. That the idea is, hey, I'm raising capital for one business. I'm going to go do it, and then you're going to go run it. On the independent sponsor side, they're generally larger businesses, require a different level of capitalization, but you're owning them as an owner, as a chairman, as a sponsor, and having a professional management team underneath. So those are generally the best deals. And the economics are different as well.
So Bryan, one of the things that blew me away at that conference, I think you pitched, I think there was over 1,000 private equity firms that were actually dying to have you bring them a deal.
Yep.
That's what blew me away. That was what was shocking. SBA is not sitting there like when you go into the other world right there, you're talking about non-recourse financing. You're talking about growth partners. That's the stuff that I came back to Feras and I was like, oh my God, this is the space. So dive into more of that stuff.
Right. And that's why, the space has grown because of that same dynamic. Because what's happened is if you're a private equity fund with a large pool of committed capital, you're jamming up and competing against all of your peers in a market that's gotten increasingly crowded over the past, especially decade, but even more than that. And so to the extent someone comes and they've worked their network, whether they're kind of aggressive business people who have an industry expertise, whether they're just kind of a country club deal where they just struck gold, somebody can come and have a deal that is just not what the institutions are able to find. And so for that person to come and say, hey, I've got a deal under contract, I just need your capital, it's a win-win. It's something they could never get through the banks. That individual now didn't have to go through the pain of raising the equity. And for sort of a different share split, it's a win for everybody. And frankly, one of the dirty secrets for overworked, kind of overexpanded private equity firms, having an independent sponsor who's going to do the day-to-day work, who's going to really be in there every day. And so now the private equity firm can kind of just weigh in and do their call every other week rather than kind of, going out to Cleveland to go to these industry conferences and all that kind of stuff. That's a real value to those private equity firms as well. So it's not just finding off-market or cheap deals, but having sort of an experienced hand at the wheel who has their own skin in the game. It's a win-win for both sides. And that's why you've seen the market explode.
Awesome. And I do want to dive into kind of maybe people better understanding what those deal structures look like. But before we do that really quick, Bryan, you want to kind of just give a little bit of your background as well and kind of what led to where you are today?
Sure. I'll give you kind of the quick background. I'm Bryan Rand. I'm CEO of Rand & Co. Holdings. We are a private holding company where we own a number of different platforms, private businesses across different industries and geographies all across the United States. Where we are different than many firms is we've actually used our own capital or those of our close partners to buy these businesses on the equity side. And so, our preferred holding period is forever, right? But that said, every once in a while, we're capitalists. We can move in and out. And so we're different than an institutional private equity fund because we haven't, raised a committed third-party fund. But we're even different than many independent sponsors in that we don't always go and raise institutional equity to do a deal. We've been fortunate over the past decade to build a meaningful platform that generates cash flow, and we can use our cash flow to do the deals. But because of my background, I grew up in that investment banking and private equity world. I started out of undergrad, went to undergrad at Morehouse College, my alma mater I'm super proud of. Went up to New York, Credit Suisse, did investment banking. Credit Suisse actually paid for me to go to Harvard Business School, brought me back in their private equity group. And frankly, I would have spent my whole life there. But what ended up happening was in 2009, the world was blowing up during the financial crisis. Credit Suisse actually said, hey, we're getting out of the private equity business. We don't want to do this illiquid investing. We don't want to compete against our clients. And so I actually partnered with the gentleman who's the head of the special situations group at that time, which was a debt fund that did exotic investments. I'd met him through work. There had been deals where I was in the private equity group as a junior professional. He was the head of that debt group. And so we would look at buying companies where the private equity may own the equity and then he could provide the debt. So we built a relationship. And he came to me and said, hey, they're closing my business as well. I want to make a bid and buy it from the bank. And so a very long story short, we actually got that deal done, found the money in Asia, got a very attractive seller financing deal from the bank because they wanted the loans off of the books. And as many of you know, the junk actually snapped back the hardest. So a year and a day after we did that deal, we're able to exit the majority of the portfolio for a north of 10x return. And so it's just one of these kind of great moments in capitalism. And post that, the folks who were involved, some kind of stayed and kind of wanted to do that. I kind of was in a position where I wanted to kind of see what was out there and kind of had moved to doing some kind of independent advising and investing because we'd had some success, right? And so I didn't want to be a kind of mid-level at ABC Capital anymore. But kind of having had that experience, what I saw was, look, I don't think I want to be just another provider of capital. That from my perspective, private equity guys, they're great. There's a real function in the system and it's a great way to build wealth. But the kind of impact I wanted to have would be different. On my obituary, on my headstone, I don't want to just be say he sold money, right? Because at the end of the day, private equity guys are just out selling money. Right. And I think there's a chance to kind of really build meaningful businesses. And so I fast forwarded from that moment on the back of that success to doing some small advising and investing and begin to interact with different companies where I could buy a small stake, really understand what it was to truly be an investor with your own capital. And then what that has progressed into was where we are today, where some of those businesses that we've invested in and the team that I built began to have meaningful success, really took off, generate cash flow and wins that we've been able to double down and reinvest. And so that's really become a virtuous cycle where we said, hey, we think we can do it. And I'm happy to tell you a little bit about our model, but if you kind of ask about our story, kind of think growing up in institutional private equity and
I love it.
Having that spin out and then really moving into where we are today.
We're talking about a lot of this is also what we call the lower middle market, right? This is that space where a lot of the bigger private equity is not really wanting to get down. So they want to find the Bryan, they want to find the Casey and Feras that are looking for those lower middle market deals to go and put it all together, right? So I think when last time we talked, you'd had, I think 10 companies in your portfolio, maybe more. You have thousands of employees. I mean, you have some pretty good staggering numbers on your growth. If you don't mind sharing with us kind of the success you guys have had.
Sure. So, I'm proud of what we've done, right? And it hasn't been an accident.
Now, people just see the finished product and don't realize all the slog to get there. Trust me.
Oh my gosh! I mean, I feel like we could scare off a couple of listeners, but also maybe attract a couple on just the actual reality of owning these businesses, right? People see the end product, but they don't see capital calls and stress and the lawsuits and everything that comes with it. But just tell you a little bit about our platform. We really do two types of deals. We'll do one, what we call a legacy buyout. And so a legacy buyout is we like to buy a business that's been around at least 30 to 40 years. So I'm generally buying directly from kind of a baby boomer or a group of a family. And in those businesses, we like a very specific dynamic where we want a business that has been very steady, but generally has some level of hair, some level of complexity, some level of difficulty that will scare folks off. And then we will bring in a CEO who has been in that industry and had success at exactly the level we want to achieve. So like where we would be different from an ETA or searcher is all respect to other folks. A lot of people do it well, but I always use the kind of the joke. We're not partnering with guys in blue jackets or girls in pencil skirts who kind of just tell us where they used to work or that they have a good idea. I want someone who's done it exactly. So I'll give an example in our portfolio. We own Finco Solutions. Finco Solutions makes steel furniture for corporations. I'll give an example. We're the largest producer of under-counter steel at banks in the country. So if you think drawers, lock boxes, we make them for many of the banks in the United States, right? On that, the business also makes steel lab equipment. So think fume hoods and chairs. We make checkout counters for many dollar stores and other retailers. But when we were buying that business, there were a number of people who heard, wait, you make under-counter steel at banks? Bank branches are closing, and wanted to run away. And so for us, we looked at it and said, hey, actually, when you really look into this, lab has got great tailwinds, is a high growing sector, and that this bank side is super, super resilient. And so I love a situation. So Casey, when the world sees a melting ice cube, I see them get mispriced over and over. They think it's going to melt faster than it does. And so I can go buy that and experience the growth, but then have the call option, right? Kind of think of the bond of the steady business, but the call option of the growing business. And they get mispriced. And that was a great example. And so that was the business where when we bought it was, just under 20 million in revenue, 3 million of EBITDA. And since then, we've grown revenue, more than doubled revenue, significantly grown EBITDA. That was a business where, just to give some of your listeners the detail that I think they're looking for.
Absolutely.
Where our model was a little different was we were able to get a cash flow loan from a great lender that we've enjoyed working with, and that has been a great partner. We were able to structure a specific deal on related to the real estate, where we were able to execute a sale-leaseback on the real estate. And then I wrote a check for the equity and I own it. So it's not like an equity deal.
We're going to break that down, brother, because I'm telling you right now, that is it's gold. Because these are things that and I'm telling you to our listeners, right now, I've just learned about a sale-leaseback literally 6 months ago. I left the same conference that you were at, bumped into a group, and they said, have you ever heard of this? And I was like, honestly, I never thought about it, and it blew me away, right? So let's kind of peel back the onion there.
Yeah, and for the sale-leaseback, and it's funny because I've known about sale-leaseback, but never really registered about doing it in this context, right? Because, for those listeners, if you have a seller that wants to sell the real estate, like we have an example of this right now where the seller, hey, I need someone to buy it all. He doesn't want to sell just the business, right? You can either buy the real estate, which typically you're paying a much higher premium than what a business, right? 4X multiple versus a 5X cap, which is, significant difference in terms of valuations. You got to bring a bigger check amount for that real estate, or you find a company that's okay taking on that lower yield, that lower return. Real estate's considered, very low risk, and that's why they'll accept it. And they will basically cash out the seller. But now, if you're smart about it, right, you can actually play with your rents to use it as a mechanism to get cash out. And so what we mean by that is ultimately the value of the real estate that a company will buy it for is tied to what rents are being paid.
Exactly.
And so, Bryan, in your example, if you know that you can afford to, let's just make it simple, pay another $10,000 more a month in rent, well, that $10,000, $120,000 of cash a year, that at a 5 cap, you're probably taking about $2 million of value added to the real estate that a sale-leaseback will pay that premium for. And now you can use that to get $2 million out of maybe what the seller wanted to actually apply to the equity check that you're going to have to bring.
I mean, you described it perfectly. And what's been great is as the capital markets have evolved, right, and more independent sponsors and private equity firms are doing more and more business in the middle market, there's multiple ways to do it. So now there are a number of my email box probably, I get 4 folks a day saying, hey, can we do your sale-leasebacks? Because they only want the real estate, right? And so what's happened is, to your point, one, you can go to many of these folks, and I say boomer owners because it's such a prevalent part of the mid-market where...
especially in legacy buyouts.
In legacy buyouts, right, where folks will have a business, but they also own the real estate. And often they own the real estate either unlevered or they own it at very low leverage because they've had it for a long time. They may charge themselves some rent, but they don't charge themselves, to your point, a market rent. Wow. And so if you're buying a business and you look at it and you say, hey, this business can afford, this is a very stable business. It's a legacy business. It's been around for a long time. It can afford a market rent. The price that you pay for that business can potentially be a way to arbitrage the ownership of the business down to a lower price. So I'll give an example just so it's crystal clear. in a world where you can, to your point, increase that rent, if you make a combined offer for the business and the real estate, in their mind, they have the real estate often valued with the rent they're paying. But if you can increase that to a market rent, you can actually say, hey, we're going to pay you, just to use an example, we'll pay you $20 million for the business. And in their mind, they think, hey, the business and the real estate, and they think the real estate's worth $8 million. But if you can increase those rents to a market level, you can't get too cute, but if to a market level, and it's actually worth 10, and then you have someone else buy that for 10, or you structure it that, then you now own the business. Instead of paying 12 for the business, you paid 10. Yeah. And then, you get your cash flow loan based off of the new revised cash flow.
All right, now let's talk about that cash flow loan, because this is that part where we were at the conference together. So these guys, you're talking about non-recourse, right? So we're not pledging our houses and things like that I have an SBA loan, so I know how that works.
Third born, in case you said.
I know how it works. So then I learned about this. I'm like, oh my God. So talk a little bit about that private credit, that finance side.
Sure. So the private credit market has just exploded over the past 15 years. There's been it's gone stratospheric as interest rate raised over the past couple of years. But where I think the markets have changed, to your point, for the folks that will be listening to this, is there are so many providers of cash flow loans that you can use to buy, finance, grow, or refinance your businesses that didn't exist. And that, frankly, I have found them better sources of capital than the big money center banks, right? That they are better set up to do deals. They're set up to move more quickly. The money's more expensive, often in rate. But what's relevant for our listeners is if you think that you've got, for instance, the 5-year hold period, you may be willing to pay a little bit more rate because these cash flow loans often don't have amortization. So your, loan that you got from, the local term loan, whether it was, Chase or whether it was Live Oak or these guys, has both interest and amort. And if you think you're going to have 5-year hold, you think you're going to grow pretty quickly, you feel good about, what you're doing, then frankly, the actual cash burden on the business, which for us as sponsors, for us as investors, is what matters. At the end of the day, whether it's going to pay down debt or whether it's going to pay interest, our point is, can we make the payment? And if you know you can make the payment, then actually, like having a cash flow loan, it's more flexible. Now, it's more rate. And then in some instances, they may require some equity, some participation. But frankly, as I've learned, the better the deal, the better you can negotiate. And one thing that I think will be useful for people is the more thought you put in, the more time, the more baked you are, I think the better chance you have of getting this done. And frankly, these loans, they used to only be available to, 5 to 10 million of EBITDA plus. Then they were only available to 3 million of EBITDA. Honestly, the credit markets have changed. I'm not saying they're easy to find, but there are folks out there who will do, $1, $3, $5 million cash flow loans. Now, they want a quality partner. Sure. They may not be the first person they may not be a great bet for your first deal, but they actually exist. And so when we were at that conference, me finding folks who I may find a really interesting opportunity that starts small. And so being able to find a cash flow loan where I don't need to have guarantees, where I can have somebody who can kind of go to committee. I know I can get a deal done in 30 or 45 days. It's actually very valuable to have the folks who can do the small ones, especially when you're using your own capital like me. So,
it's huge. It's huge. You use sales leaseback, cash flow loan, and you get a good seller carry note right there. Then I'm talking all day long. Great deal. I did not
Everybody's happy.
Yeah, I did not know about private credit when we did our acquisition of H&M. It's a $20 million acquisition. There's a lot of PGs. We threw anything and everything to get it done, right? It was like whatever it takes. Now we're looking back. We're going, okay, we're about to make another acquisition bolt on. We've already had a couple conversations with a few people, and they're like, hey, you get deal number 2 done. Get that NOI where it's at. We'll take it all out. And we like the idea of private credit.
Yeah, I mean, frankly, I bet I wouldn't be surprised if you could refi using one of these cash flow guys to do number 2. So one other thing I want to throw out there, Casey, just because I have found it valuable and I don't see it a lot in the market. So when we're buying businesses, we're often not always buying 100%, right? And so we're buying control. And so whether we buy 50, 60, whatever, purchase options, I have found sellers often frequently discount, right? If you really feel like you've got a path to grow, building in an option to say, hey, I've got a right to buy, and pick a number. It may even feel like a high one, but at a 30% premium, a 40% premium, whatever a set multiple. But being able to say, hey, for the next 5 years, I can buy more of this thing. People really often underprice that, right? Because at the end of the day, they care about their cash at close. But where there's real value for us as folks who can just think longer than that term is really getting that value. So yeah, you may have that seller note, but you may say, hey, I've got the right to buy it out on really attractive terms. And at that point, what they really care about is their cash at close.
And in their mind, they think that number is already so big that, of course, I'd sell it for a 20% premium. But then they don't realize that, hey, in the course of 5 years, maybe if you have a handle on it, you double the business. And now that 20% really left 80% on the table. So, and it's usually levered up. So it's really left even more than 20% on the table. Right. So,
and having that pre-negotiated is what's so critical.
No, it's one of those things, like I said, I tell people, like, there are some simple things that you basically are give me's that any seller will agree to, that they're your ripcord. They're there if you need it. And if it works out, now you've really, made something very, very valuable.
Yep. So let me go. I want to talk just really briefly about the second type of deal we do, so that you kind of. So we talked about legacy buyouts, and I think people are pretty familiar with that model. And it sounds, we have our spin on it, but that's, I think, more common. The second thing we do is what we call a growth partnership, where we will either start from zero or buy a really small platform. But what we'll do is we want to find an industry where there are large private equity players or large public companies that dominate the market, where they say, hey, you can have it any color you want as long as it's black. And what we want to do is go find a superstar stud operator. Anything we do, it's going to start with, we're not running this company day to day. We are governance, we are financial and strategic support. But finding someone who has kind of excelled in that space, and we want to build the speedboat to go fight the aircraft carriers. And so we've seen it over and over that all of these folks, especially when they're private equity backed, when they're levered, all of the decision making gets made at the MBAs. The MBAs and the suits are making that. But the operators want people who can respond quickly. So I'll give an example. I got a call from someone who I'd looked at years ago, I looked at doing deals with out in the oil field. And he said, hey, my mentee, just really had a tough time. Major private equity firm bought his company. They actually changed his region and cut his commission substantially. And so he said, I just can't work with these people. It's not right. This isn't. And so we took a look, and betting on ourselves, I had the lawyers look. They said his non-compete was poorly written for Texas. It was. And we actually started a business where we would be taking fuel from Corpus Christi out to the fracs. If you could imagine that's a 24/7 business. When something goes wrong, they can't drill. So they need responsiveness. They need thoughtfulness. As I have learned very painfully, it is also a deeply capital intensive business. And so there's a reason that the mom and pops who can pick up the phone immediately didn't get that big, because in the oil field, it's not a trust business. If you buy fuel, you pay for it the next day. When you service an energy customer, they pay, if you're lucky, in 10 days. Most likely they pay you in 30.
As we know, 60.
Yeah. So growing a business is very, very capital intensive. But we saw this opportunity to take this gentleman who'd been a number one salesperson, who had deep relationships, where we said, hey, we're not going to go you call your old customers directly, but you can stay in the business. And I've given you all this preamble. That was in May of 22. We started from zero. We've now built a business where last month we did $15 million of revenue. We did it at double-digit EBITDA margin. We own it unlevered. It's an awesome opportunity to go, and we want to build these speedboats. And I can see it over and over in different industries where you can really build a best-of-breed platform to go contact. And so, when you look at our platform, I'd say half of these are growth partnerships where I've either bought something really small, but each time I went to the operator and I said, I want you to do exactly what you've done before. I'm not asking you to to pivot. I'm not do exactly what you've done before, but this time you're going to do it as CEO and a co-owner. And that's been our model. So we're doing legacy buyouts, we're doing growth partnerships, and I think there's room, and we've been doubling down. We've been using cash flow to do new deals. We've had some success. I've grown my team substantially, but all of us are bought into this model.
No, and I think
you got Feras excited here.
No, well, because it's the same stuff that
you're talking similar. Yes.
Yeah, I mean, you're quantifying a lot of the same things that we're seeing, right? I think there's huge opportunities, a huge ecosystem out there, and Bryan, we're going to do a deal together sometime here soon too. But the question I have for you, though,
but Feras, one of the things I like just about our vibe. I always tell people, if you make the pie big enough, you don't have to worry about the size of the slices.
Yes, I 100% agree with you. I mean, it's better to have a smaller slice of a big pie than a big slice of nothing. So
we're not fighting each other. But they say, whatever it is, 10% of a watermelon instead of 100% of a grape. But frankly, I'd rather have 1% of the farm, right? So the way I kind of look at this
better analogy. I should use that one.
I think so many of these folks are think that we're competing against each other. And I'm saying that our economy is so robust. There's so many opportunities, especially where we are in the mid-market. Frankly, when you're at the top of the market, there's only so many times you can write $1.5 billion, a $1 billion check. There's only so many companies for sale that support it. And so those folks are fighting. For us, we can work together. We can swap, best notes. Hey, this is my experience with this lender or this QOV provider. And everybody wins, right? There's more than enough for us to create amazing lives for ourselves, our families, and stakeholders.
And you told me that at the conference. You told me that, Ron. We talked 5 minutes. You gave me your spiel. We bumped into each other a couple more times. But you said that exact thing. You're like, hey, man, I'm an open book. I think we've got a ton of opportunity. And that's what's so awesome about what you're doing and your connections and what you're creating there, man. Now, let me ask you this. Let's just say one of our listeners is saying, hey, I want to work for a Bryan. I want to work for somebody like that. I mean, are you looking for people, or are you looking for sharp people?
I am always looking for people. So
it's all about the people, man. The more we've grown, I've realized it's all our time needs to be spent finding people and nothing else.
All of us are in the people business. Every business is the people business. There's nothing else. So, what's funny is I meet so many folks who try to be hard to find. That's just not where we are. Everybody on my team, your email's on the website. Your LinkedIn's on the website. I want you to reach out. That I'm not that busy. And I have found so many deals where, the frog that I kissed was the prince that we got. I had to kiss 3 frogs to get there, right? Our average gestation period is probably north of almost 2 years from first interaction to getting a deal done. But I would argue it's supposed to be that way, right? The idea of just, I'm going to meet a stranger in an industry I don't know because a banker I don't know sent me a book, and that 6 months later, 90 days later, I'm going to own that company and we're going to have a great outcome. That's different. So to your point, Feras, you got to go, like you said, do the meetings,
getting out there,
the people, the outreach, because I got connected with the CEO of the fuel platform for a deal that we didn't do, but he, respected that I'm a straight shooter, respected that I had good, a good reputation. And I got that call 4 years later. And, I'm fine with that, right? I'm hoping to be doing this for a long time. So that was a lot of answer to your question, but hopefully good context.
Yeah. So 2 quick questions for you, because I think people, there's questions that I have at least. Yeah. First one, being the best technician, right, the best salesman on the team is very different than starting something from zero. So how do you have the confidence that a person, that had the systems in place that performed well, that's the hard part, right, of what we do. And
I love that question.
The way I look at our platform is we're there to give them almost like the system and kind of babysit them through that, because 0 to 1 is a lot harder, I think, than 1 to 2 in a lot of ways, right? And so how do you place that bet?
I love that question. From my perspective, I look at someone and I say, hey, I want you to be able to win the work and I want you to be able to deliver the work. But you don't need to worry about the money. You don't need to worry about the accounting. You don't need to worry about kind of marketing, sales, and systems, right? People who are used to institutional level, comms and marketing and all that, they don't even understand how difficult that is to build, and they don't need to. But if I can find a practitioner who has either run a P&L, run a sales organization, and then we are in position to support the other activities, that's where 1+1 equals more than 2. Now, I'm also happy to share with you, like, we haven't defied gravity. And I can tell you where I misfired was related to some of these same points, right? The deals that have been tough, where I looked at someone who could really sell, and I knew we could we could do the finance, we could provide them, with capital. And so I was excited when we put these together, but I didn't understand that, like, hey, this business, the procurement and operations function was super important. And the folks that I dealt with had success as salespeople, but we underestimated that part of the business. And so to your point, I've got to really truly look at it. What does it take to both win and deliver work successfully? And I need a CEO who can own that piece of the business. And in my experience, they got to want to do that, right? They can't be wanting to go do something else. I want people who truly are passionate about it. They like it. They like leading and managing people. If they are rushing to get to the chairman seat, it's generally not the right partnership. I want someone who, that's one of the reasons why we've been so successful, taking people who haven't had the CEO title yet, right? They ran a region, they ran a P&L, they were, ops, they actually know how to win and do the bit. We don't have any question about what to do day one, but they, them having the keys.
Yeah, it's funny. It's a lot like the diagram I drew for Casey 2 years ago, right? Which is, I call it the backbone, right? Sales, marketing, HR, IT, accounting, and legal. Those are things that we can provide. And we looked at it from existing businesses, right. But to your point, that's also the jetpack that you can put on someone's back that knows the rest of the day-to-day of that business, lacks those things to kind of help enable those things. So they're not trying to figure out, how do I set up a payroll system? What is the best? All of the minutia that is important for a business, but not core to that business. And so, yeah.
Right. So I agree. I think sales has been tough, but then part of our model has been, it either needs to have been around 30 or 40 years.
Right. So you have that database,
right?
So that customer.
It's kind of business. It's proved that it matters to the market. Right. And what I have found, I don't know about you guys, many of these businesses haven't made 5 outbound sales calls a month in 20 years. Right. That, they're meaningful institutions, but they're not hungry. They're not scrappy. They're not built to do that. Frankly, if they were, they'd be bigger businesses and we wouldn't see them.
And you wouldn't be buying them.
And so the sales, yeah, exactly. The sales piece is a interesting piece of that. I love. We'll talk offline. I'd love to kind of hear sort of how you think about injecting that.
I'll tell you this. We've been going down a road because we want to get into the wastewater treatment industry here in Texas, right? So last year we went through a 9-month process. Seller, I think I got a little too exotic on the deal structure, and but also his accounts receivable just dried up. So it did not work out. I know it will come back. Going back to your 2-year process, we ended good relationship, all the above. But at the same time, a very little deal with a big brand, but a very little company popped up, and we were like, this would be a great bolt-on. So we were starting that conversation at the same time. Now that big one's gone, the little one's there, and we're like, oh my God! But we got to do it. It will make the bigger one better, and I know that one's going to pop up. But see, that's the cool part about being an entrepreneur, right? Thinking about us as in the acquisition space, and so I'm glad you talked about your growth strategy too, because if you're just the guy that buys the historical, long-lasting old business, I'm not saying there's anything wrong with that. We have done that, but then there's also this opportunity for us to go, man. There's just opportunity in these markets, and sometimes you just got to take that entrepreneurial risk and go at it.
100%.
Awesome.
100%.
Perfect. Well, no, Bryan, lots of information in this one. And one last thing before we move on to our rocket round, for the deal with the safe boxes, right, that you mentioned, can you give people just really quickly, what were the terms of the loan, right? How much leverage, how much equity, how much seller carry, and what was the rate just for the whole package on that?
Sure. I want to be respectful to the family that we bought from. So I'm happy to give kind of higher level, but not give the details. So, it was an approximately 3 times cash flow loan. Our rate relative to sort of where market was, we felt like, again, at that time, I think we were, SOFR plus, 500 and change, maybe a
500,
little bit higher. But for us, we did sign up for some amortization there. Right. And my view on that was I truly plan to own this business. This is not built to be a flip. And so as painful as it is and using up the cash to delever, frankly, like being in this position on a project-based business where less debt is really a good thing. One of the reasons these folks were around for us to buy 40 years after, Grandpa started it was because, they had owned it debt-free. And so we will eventually go there. And so we did a cash flow loan. I'm happy. Anyone who listens to this and wants to know more, you send me an email. We'll talk through that detail. So I'll get the rate right. But that's sort of how what we saw there. Yep.
Got it. And maybe let me ask you a question. What percentage of the equity did you end up having to bring at the finish line?
So this was an interesting conversation. So because of our model and some of the success, I wrote 100% of the check. But I would tell you is that we felt good about how we structured the deal. And so like relative to many deals, I think our percent, again, just out of privacy and respect for the folks we talked about, I won't do the specifics. But if you get it right and you really do the work, you'd be surprised that like people will support deals that have relatively, the debt equity max does not always need to be 50-50. We were significantly below that. And so I guess just really quick before you get to rock around, two things I would say have really made a big difference. Being willing to spend a little bit of money on legal and accounting will differentiate your listeners significantly from like 90% of the folks in the deals they're seeing, right? Because 90%, they've either talked to somebody one-off or they got a book, but just being able to put a third-party stamp on, hey, these folks have looked at it, this is our review. Because as much as people tell you they want to do proprietary deals, whether it's your equity investors or your lenders, nobody thinks like that. I've never seen it. They all prefer a beautiful package, a beautiful model, a beautiful third-party stamp. And so being willing to spend a little bit of money on that, you'd be surprised how much comfort these lenders can get saying, hey, you know what? I need to get some money out the door. I'm willing to do this deal, even if the equity stack isn't as deep as possible. So
there you go. No, it's all about advice. It's all about structuring.
I got beat up when I pitched that one private credit guy. He said, man, you didn't put the presentation together. And I was like, well, I was just seeing if you were interested. He was like, I'm always interested. Put the package together.
That's it. Exactly.
Awesome. Let's jump into our rocket round. This is where we take our guest and ask them a few questions. So,
all right.
Let's jump into it.
First question. What do you like to do in your free time?
So free time is tough. I've got 6-year-old twins. My oldest is 24. But, when I can break out of the family time moments and what we're doing with our business, you'll find me on the golf course.
Yeah, one day I'm going to go learn golf because I'm clearly in the wrong business if I don't. So
all my golf dollars go to my daughter. She's our golfer.
Okay.
All right. Next question. So what's your most memorable moment in your business journey?
I think for sure the decision to spin out and put my name on the door and do, really kind of go into business and tell folks that I'm doing this was 100%. Because, until you do it, it's talk. You can listen to podcasts, you go to conferences, but actually kind of decision and kind of takes a lot of courage to tell, your spouse and your friends and your family, especially, I had a very strong traditional background, right? That, they're like, hey, why aren't you just, going and working for Blackstone or some of these guys that we've heard, but going to do my own thing. What that period was like, that's to me, that's in hindsight, the fun part, but was as scary and most memorable as it could be.
No, you had the Wall Street names and it's like, why would you leave that? I had the same thing when I left Microsoft. Why would you leave that? And it's like, hey, there's always better things out there. So Great. And then last question, favorite tool or resource?
So a two-part answer. So first, I would say the phone. If you give me the phone, we will make it work. You put me a phone anywhere in the world and, we're going to create some value. I would say that is not changing. And I think that's going to be for a while. Look, I'm seeing these AI tools. They have changed my workflow literally over the past 9 months. I won't send an email that hasn't been through ChatGPT, right? When I kind of talk to my team and I say, before you ask me a question, has this question been put in Google, YouTube, and ChatGPT? Right. Because the answers are probably there. So I'm seeing those, the AI kind of tools begin to change sort of my workflow, the workflows of the companies we invest in. And so it's kind of creeping up the list. But, right now I feel like if you give me a phone and, you could drop me in a country I barely speak the language and, give me 5 years and a phone, and, I think we'll do okay.
Hey, the phone is my friend too. I love it. I will pick that thing up and call anyone. I love it. That is fantastic.
Exactly.
Well, Bryan, listen, it has been an absolute pleasure. I would love to let our listeners know we're going to get you out to our conference in May 3rd, be a part of that. We're going to definitely be bringing this independent sponsor conversation to what we're doing because it's a big thing. I talk to all types of people that I talk to that have never bought a business, always say they're going to buy 2 or 3. And so I love the vision, right? Yep. So how do I get there?
Love it. So look, I'm looking forward to being there in May and looking forward to connecting with folks. Yep.
Awesome. And Bryan, how can the listeners get a hold of you?
Sure. So my email's on my website. So if you go to Rand, RAND-CO.com, you go on there, you'll see both about our business. You'll see some of my team and you reach out. I'm happy to chat with folks.
Awesome. Bryan, absolute pleasure. Thank you very much.
Thanks, Bryan.
Thanks, everybody. Take care.
Thank you for listening to the M&A Launchpad podcast. If you've enjoyed today's podcast and would like to support us, please leave us a rating and a review after you listen. I'm Casey Minshew, and I look forward to talking with you next week.